I'm joined today by Jason Schreiber, Principal and Co-Head of Real Estate Equity at CIM Group. Jason is among the incredible investors sharing insights at the Private Wealth Investment Leaders Forum today. Welcome, Jason. It's great to have you with us.
Thanks for having me.
How is today's net lease market different from where it was just a few years ago?
I think the market has certainly matured and the investor sphere has definitely matured. So versus simply focusing on the duration of the leases, long term of assets, we have a lot more focus in credit discipline. So managers and investors in the net lease space are focused on the credit worthiness of the tenant, the type of their lease guarantee. There's more of a focus on the fine print in the agreement, as well as a variety of terms beyond simply just the fact that this is a triple net lease where the tenant is providing for and paying for all of the operating expenses and CapEx.
What types of tenants and sectors are attracting the most investor interest right now?
So in the US today, probably similar in many parts of the world, there's increasing shakiness in consumer confidence levels, as well as there's a lot of geopolitical volatility. And what that means is investors such as ourselves are going to focus even more so on the essential nature of the tenant's product offering, right? And so we're looking within retail at essential services, grocers, wholesale companies, gas stations, convenience stores. That's versus discretionary retail, such as experiential retail, movie theaters, bowling alleys, entertainment, soft goods, apparel. Much more of a focus on everyday retail that even in a down cycle in the economy still sees high levels of patronage and is able to prop up as much spend as possible.
Why has net lease real estate become increasingly attractive to international investors?
Part of what is attractive about net lease is not just the stability and predictability of the cash flow, but if you look at the net lease sector, which is largely a core plus asset risk profile versus other core plus offerings in the US, there's about a 200 to 300 basis point premium in the net distribution yield or the current income yield, and that's attractive for investors.
How are the higher interest rates changing how net lease deals are underwritten?
A lot more focus, even more so than before, on the financial stability of the tenant, right? We have a counterparty where historically a lot more focus on the cash flow statement, on the free cash flow generation of the company, its ability to service the debt. Now there's more of a balance sheet focus, which is looking at the debt maturity profile, the rollover profile of a tenant's existing corporate debt, when it's coming due, their ability to withstand refinancing in an atmosphere today where you have higher interest rates.
And looking ahead, where do you see the biggest opportunities in net lease investing?
So we invest in both retail, essential retail, as well as mission critical industrial. At the same time, the focus is how mission critical is that to the tenant? Is this tenant going to perform, continue to own and operate through the life of the lease in this particular facility? Is that manufacturing facility generating the core products which are contributing the majority of the revenue and the EBITDA to the company's performance? That's where we're focused. And so you can spread a little farther geographically, so long as you get comfortable with the backfill risk. Low default rates in the industry, amongst the lowest in real estate, but you still always want to make sure you have a plan B.
Thank you, Jason. We're going to need to leave it there and get back to the forum. I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Private Wealth Investment Leaders Forum.
Great. Thanks for having me.